Freedom Foods is an ASX-listed company that revealed a surprise blowout of losses of over $500 million. Freedom Foods was accused of withholding material information regarding the true state of its financial information after it admitted that its past financial results were inaccurate. So, what is material information? An item or issue is considered to be material if its inclusion or omission can influence the economic decision of a user of the financial statements. For audit purposes, materiality is therefore the highest level of misstatement that can be tolerated by users of the financial statements. Misstatements beyond the overall materiality threshold will result in the auditor concluding that the financial statements are not fairly stated. Unfortunately, there is no universally agreed formula or criteria for determining the materiality threshold. It therefore involves the exercise of professional judgment. ISA 320, paragraph A8 gives examples of benchmarks and percentages that can be utilized. These include 5% of profit before tax from continuing operations for profit-making businesses, 1% of total revenue or total expenses for a not-for-profit entity. The choice of the benchmark to use depends on its relevance, reliability, and predictability. As an example, profit will likely be utilized if the organization has stable earnings, which represents a true reflection of the company's level of operations. A different benchmark, such as net assets or revenue, will however be used if the profits fluctuate significantly from year to year. In setting the overall materiality, the auditor should also consider qualitative factors such as the complexity of its transactions, the nature of those transactions, and whether the organization has a history of errors and fraud. As can be noted, the overall materiality threshold is therefore quite high. As an example, if a business has a profit of 100 million and the threshold is set at 5%, the overall materiality will be 5 million. There is therefore a risk that the auditor could fail to identify smaller errors, which in aggregate could be higher than this amount. To reduce this risk, for audit planning purposes, the auditor will reduce this overall materiality by calculating a performance materiality. And it is this threshold that will be applied on audit procedures. Performance materiality is generally set at 50 to 75% of overall materiality. The auditor can also set performance materiality thresholds for particular classes of transactions, balances, or disclosures. Materiality thresholds can be adjusted in the course of the audit if the auditor becomes aware of information that indicates that the threshold is not appropriate. As an example, the auditor will reduce the threshold if significant errors are discovered across a number of financial statement items. To recap, misstatements are considered material if they can influence economic decisions of users of the financial statements. The overall materiality threshold is set to highlight the highest tolerable error that is acceptable to users. Uncorrected misstatements, whether individually or in aggregate, that are higher than the overall materiality will result in the auditor concluding that the financial statements are not fairly stated. The auditor will set a lower threshold referred to as performance materiality when performing audit procedures to lower the probability that uncorrected and undetected misstatements exceed overall materiality.